Right, good evening, or late to good afternoon, ladies and gentlemen. Welcome back. The high point of our day is about to start, and I'm not talking about me whatsoever. We've had a fascinating day looking at CBDC, both wholesale, retail, arguing the pros and cons of it. And so I'm absolutely delighted, Caroline, that you have accepted an invitation to join us from the Bank of England, where I know there are one or two things going on. There's some little announcement tomorrow, isn't there, which you seem reluctant to talk to me about. But anyway, figure of 25 basis points crossed my mind. I don't know why. And so the Bank of England has been doing an awful lot of work on this of late, and publishing documents, including the recent consultation paper, technology working paper. So delighted that you agreed to come and share some of these thoughts with us, because it'll be a very useful addition to what we've been talking about today. Caroline, apologies, I must introduce her, is a fascinating lady. She's a former deputy governor of the Central Bank of Canada, which has a great reputation in supplying excellent bankers to the United Kingdom, and currently is an external member of the Bank of England's Financial Policy Committee. She's also a senior research scholar and professor at Princeton University, and amongst a range of other activities, I note she is a guest mentor for the FinTech stream at Oxford University's Creative Destruction Lab. Now, when I was up at Oxford, creative destruction meant several glasses of beer, which then got flung around the quad, but I presume it's somewhat different these days.
Yes.
So I'm delighted to present Caroline Wilkins, who's going to talk to us about money, a question of purpose and trust, and then field your questions.
Excellent. Well, thank you so much for that generous introduction, and it's just such a pleasure to be here at OMFIF with this annual global conference on central banking and digital currency. Anybody who knows me knows this is very close to my heart. I won't keep my central bank license if I don't say that these views represent my own views, not those of my FPC colleagues. And with that, I'll just start by saying that when I thought about giving this talk, I was looking at the last decade and thinking about how the whole work of central bank digital currency started off as kind of a research project, a very interesting thought exercise. And that's certainly how we thought of it at the Bank of Canada. But now it's turned into a topic that's related to actual pilots, actual design and technology choices. And there's over 100 central banks, as you all well know, given your discussions today, that have been working on it. There's, I don't know, it changes a lot on this website that I'm looking at, but right now there seem to be 29 CBDCs that have been piloted or introduced in jurisdictions. And so it's not surprising that this discussion of CBDC and the work on it has been the subject of very hot debate on either side. And it is a hot public policy issue for good reason. And that's because money is at the core of any financial system. The financial system just relies on broad-based trust in money. And central bank digital currency won't be any exception to that. I myself just strongly support the private and public efforts to innovate in payments. And that's because it could have real benefits to the businesses and the households that are making payments, especially, we just heard about it, cross-border payments. Now, many of you, all of you probably who are here today, are aware that His Majesty's Treasury and the Bank of England recently released a consultation paper. And in that paper, they judged it likely that a digital pound would be needed in the future. And while the final decision hasn't been taken on whether to actually issue a digital pound, they've moved to this next stage, which is really exciting, of preparatory design work. And if you look at those two papers, there's a consultation paper and then there's a technology paper. And if you read those, it's going to become very obvious that there are a list of issues that are quite daunting that need to be resolved. And as a member, an external member of the Bank of England's Financial Policy Committee, I'm keenly aware that new forms of public money or private money could have financial stability implications for the UK globally. And these implications could be for better or for worse. We saw recently in the US, I'm teaching a class, I was teaching a course on financial crises at Princeton, and Silicon Valley Bank failed right in the middle of it, which was timely. And of course, last year we saw Terra collapse. And so these are, the deposits in banks, this algorithmic stablecoin really provides stark reminders that runs against different forms of money are likely to continue to happen, and that they could become even worse as technology evolves. And I think that's one reason why His Majesty's Treasury and the Bank of England are proceeding very carefully. We heard another central bank, the Bank of Mauritius, is proceeding carefully, and they're consulting widely on their work. So what I'd like to do today is walk through what I think of as the three fundamental principles that I think should anchor the economic and technical design of a CBDC. And the first one, which I think is the most important, is to stay focused on the core public policy objectives and really resist mission creep. The second one is to identify and mitigate financial stability risks, not surprising given where I work. And the third is to set a high bar for technology, including with regards to privacy, resiliency, and security. So the first question I get asked, and I bet you all do when you talk about it, when you start a conversation about central bank digital currency is, well, what problem are you trying to solve? It's the classic kitchen table test. In fact, my husband asked me that around the kitchen table quite a bit, and obviously I haven't satisfied him in that regard. And I think it's because people look at the access they have already to multiple sources of payments, whether it's a bank or a bank card, a credit card, a payment service like Apple Pay or Google Pay, or if you're old-fashioned like me, you still use cash sometimes. And now people will acknowledge that cross-border payments are inefficient, they're expensive, they're slow, but people that recognize that consider this to be a problem that the private sector should solve. And this is mainly because central banks aren't really typically viewed as being that innovative. It's really the private sector that is in a lot of people's minds. And I think this line of reasoning is very intuitive, yet it misses two very important considerations. And the first, the most important to me, is that central bank money is the safest asset that one can hold because it's backed by the full faith and trust in the government that issued it. And this lays a solid foundation, which I think is just obligatory for a stable monetary and financial system. And in contrast, private money is a liability of profit-seeking financial institutions, and that's fine. But it means that it's subject to credit and liquidity risks, even if we try to regulate these financial institutions as well as possible. We have deposit insurance, and that helps because it's designed to mitigate the risks of runs, and it applies to some depositors, but it doesn't apply to all depositors, as we've seen. The US banks that failed earlier this year, the first three, the share of the deposits that were uninsured were close to 90% or more. And so I think that's an issue a public policy issue that we need to resolve. Now, UK citizens, many citizens around the world have access to central bank money through cash. But we all know that its use at the point of sale is declining, and it's well known that this is likely to continue given online purchases and consumer preferences that are already driving this decline. I saw the latest statistic on this for the UK and sort of made my eyebrows go up because around 85% of the transactions in the UK no longer involve cash. So that leaves, a significant but still quite small proportion that's done in cash. And I think this is the reason why several central banks, including the Bank of England, have chosen to evaluate a retail CBDC. And that's to ensure that central bank money can remain available and useful in a modern economy in order to support monetary sovereignty and financial stability. So the second consideration is that the private sector can and likely would contribute extensively to the development and deployment of a CBDC. So this notion that all the innovation would be left to the central bank is just not the case. This consideration has prompted many central banks to prefer to distribute the CBDC in a tiered manner or a hybrid manner. There's different names for that, but it's distributed through the private sector, and that provides a platform for the private sector to do what it does well, which is innovate. So all that sounds good to my ear anyway, but there are understandably real worries about mission creep in this core purpose. And these worries are here even though the UK and many other jurisdictions appear determined to remain focused on core objectives. And of course, privacy and potential to monitor citizens tops the list of worries. At His Majesty's Treasury, it's hard to change that. Being Canadian, His Majesty's Treasury and the Bank of England are clear in their consultation paper that customer privacy would be protected, that KYC and other safeguards would be restricted to existing legislative requirements only, but people are still concerned. People are also concerned that the CBDC would allow for government-sponsored programmable money. Just think about something like a digital form of food stamp, where a CBDC could theoretically be programmed to be valid for only some purchases. This would not only be overreach, given the core goals of public money, but programming could also undermine the uniformity of money. And of course, uniformity is needed to provide a safe base to the financial system. You could imagine that a CBDC that had a program feature or programming restrictions could become a less preferred means of payment than other forms of money that had no restrictions. And so it makes sense that the digital pound would not include any government or central bank initiated programmable features, but wouldn't stop users or the private sector for setting up their own programmable payments or other forms of programming if that's what they wanted to do. A final concern that I want to talk about, there are many others, but this one I think is particularly important, and it relates to monetary policy. In theory, you could have a CBDC that could allow central banks to implement negative nominal interest rates if required to meet their monetary policy objectives. That's been particularly relevant in the post-GFC time. I think there are several reasons to reject this reasoning. For starters, it would only work if cash were no longer available. There's 1 in 5 people in the UK who prefer cash as a payments option, and it is an essential option for some people in society. And so the Bank of England's been very clear to commit to providing banknotes as long as people are demanding them. And I don't think it's surprising either that no central bank with a live CBDC or a pilot is remunerating CBDC. So in the consultation paper, they've been very clear in the UK that remunerating a digital pound to make monetary policy more effective was absolutely not a motivation for issuing one. So for the reasons that I just outlined, I think it's essential for central banks to stick in their design to the core purpose of money. And governments should consider carefully how they might codify this purpose in legislation, including restrictions on the design if those are necessary. This will help build trust in the population that mission creep will not appear sometime down the road. So even with this relatively narrow kind of public policy remit that I've been talking about, there are a number of hurdles to overcome. And top of mind for me as a member of the Financial Policy Committee are the issues related to financial system vulnerability. Some of the issues that come up, and the one that I'll focus on here, is related to the possibility of a CBDC generating bank disintermediation. And you could think about how this might arise in normal times if there was a large enough shift out of deposits into holdings of CBDC. In theory, this could affect the availability or the cost of bank credit, which wouldn't be a desirable outcome. Of course, you can study that. So the Bank of England researchers attempted to quantify this effect by evaluating a scenario where they had about 20% of deposits flowed out of bank deposits into new forms of money that included CBDC and stablecoins. And they came up with estimates that this might raise bank lending rates by about 20 basis points. Significant if you have to pay it, but from a macro point of view, not very material. But of course, they rightly note that there's a lot of uncertainty about this result. Bank of Canada folks did some scenario analysis trying to get at the same thing, looking at the 5 biggest Canadian banks, and found again that it was likely, given reasonable scenarios, that banks would be able to absorb this kind of outflow of deposits. If you look at the broader inquiry through the literature of the implications on bank intermediation and lending, not surprisingly, there's more mixed results. We're economists after all, so we've got two hands. But it does provide some insight because the differences in the results tend to come down to a number of factors. And the first factor that drives the results is the degree of competitiveness in the banking system. And so if you introduce a central bank digital currency in a system where banks have some market power in the deposits in the market, well, it may result in higher deposit rates, introduction of a CBDC. You can see that contestability would make that happen, but it wouldn't necessarily involve a contraction in bank lending, and especially if at the same time you had this lack of perfect competition and you also had access to other forms of funding like wholesale funding. However, if you have a perfectly competitive banking system, then disintermediation is actually unavoidable if the CBDC is too attractive. And so that makes the second factor in these models kind of important as well, and that's whether or not the CBDC is remunerated and at what level. So a high enough interest rate on a CBDC can lead to bank disintermediation. Of course, it's much less of a concern in normal times if you have a CBDC that does not pay interest. So again, I think from a prudent start and for a number of reasons, it's encouraging that UK authorities have made it clear that the digital pound would not bear interest. It came up in the last session that I had the pleasure of listening to, and so all these worries kind of presume that the central bank digital currency is going to be adopted. And it'll be widely adopted. People will love it. And not only people will want to use it, merchants will want to accept it, because this is a two-sided market. And in this regard, many of the CBDC pilots and the launches have disappointed, and they're experiencing really low uptake despite various incentives that are there on both sides of that market. You can see that in China, their CBDC pilot with the ECNY. It has over 260 million users. That's maybe old data, maybe they have more now. But both total wallet balances and transactions are relatively low. And there's some interesting studies about why that is. A part of it's that kitchen table discussion, which is, well, I already have other great means of payment. But Chinese authorities are well aware of this. Of course they are, and they're working with the private sector to see how they can make their CBDC more appealing and user-friendly. So I think all in all, I think the risk of disintermediation in normal times from introducing a CBDC may be overstated. The concern, though, is real when it comes to times of stress. And I said earlier there was a present and stark reminder that old-fashioned deposit runs can still happen today. We just saw it. And you can see where the run might have gone to instead of to money market funds in the US to a CBDC in that case. And I think the fact that the SVB's UK subsidiary as well experienced deposit withdrawals that amounted to 30% of their deposits in one day really brings this case home for us as well. So to be clear, the concern in my mind is not that the CBDC would be the cause of a run in the first place. The cause of the run is typically the result of some underlying problem with the bank itself or contagion of panicked depositors afterwards. Rather, the concern for me is how that run actually unfolds and whether or not the CBDC and the accompanying policies around it, including bank liquidity regulations and other things, will be stabilizing forces or not. And so I think when it comes to dealing with this worry about runs and financial stability in that context, the place to start should absolutely not be to axe plans for a CBDC. The first step should be to make sure that sound regulation and supervision are in place to reduce the chance of a run. And while UK banks have robust capital and liquidity provisions, we should probably learn some lessons from recent events in the US banking system. But after you've done that, there is a step where you want to increase the resiliency of the system in case of deposit flight. And this includes thinking about the stabilizing features that a CBDC could have, such as limits on it. Another potential stabilizing force could be the set of central bank liquidity facilities to support financial stability. And for those who say, well, maybe the central bank shouldn't, why would you put a liquidity facility in for a CBDC? I would just say you're going to have a liquidity facility anyway, because central bank currency or not, central banks will always be called in to step in when there's financial stability at risk. And our job is really to ensure a quid pro quo for access to these facilities that includes strong regulatory requirements, and those would be there to reduce the probability that these liquidity facilities are needed, but also to mitigate moral hazard. So where the rubber really hits the road is in the design of a CBDC and in the choice of technology. And here the bar has to be set really high, particularly given the central role that one would hope a CBDC would have in the financial system, and the reputational implications for the central bank of any flaws. And our colleague here from the Bank of Mauritius said that extremely well in the panel just before me. I think for the Bank of England and many other central banks, the technical design phase is still very much a work in progress. And it's going to involve making policy decisions that involve important trade-offs. Having it all at the level that you want is going to be a really hard task. And I think that's why the Bank of England said that this phase is going to take another couple of years, and only then, if they're satisfied, will they take a decision about whether or not to build a CBDC. Of course, the first step in the technical design is to decide, well, what exactly do we want the central bank to build? And here, as I mentioned, several central banks have chosen a platform or two-tiered model as the basis for the development work. And I imagine this morning when you heard about the consultation paper, you heard about what that might look like. So the conceptual model proposed in the UK has the Bank of England building a core ledger. And this core ledger would have as its sole job to provide the minimum necessary functionality for a CBDC. And the bank would also provide the API layer so that regulated private firms could access the core infrastructure. And so with that kind of model, you have the customer-facing services provided uniquely by regulated private financial firms. And That would also include, in their model, applying KYC, AML, CFT checks. It would also allow for the private sector innovation I mentioned earlier in areas like wallets or business analytics, budgeting tools, fraud monitoring. So got this model, it all looks neat and tidy in their consultation paper. So what is it that makes it so challenging, this project? And I would just start with the fact that the core ledger has to meet the highest standards with respect to 6 criteria that involve privacy, security, resilience, performance, extensibility, energy use. And meeting just each of those individually is already a really big deal. You just take privacy as an example. We've got privacy-enhancing technologies that are likely going to be needed to minimize personal data exposure, maximize security. They're going to need mechanisms to properly anonymize the customer and transaction data, but at the same time allow the bank to have access to what they're allowed to have access to, mechanisms that limit the data that payment service providers can access to the kind of legal and regulatory minima, lots of controls. But then you up the ante with the fact that there are important trade-offs that need to be faced across the 6 criteria that I mentioned. For instance, you've got security safeguards that are needed to support confidentiality and security in the data, while also making sure that users of CBDC do have access to their funds and that bad actors don't have access to the system. The challenge is that the controls that secure access to the data, like data encryption or user authentication, often make performance slower. So they have those kind of negative spillover effects on the transaction times. And you have got all these safeguarding mechanisms that need to be nimble in the sense that they need to keep ahead of potential future threats, such as those that are posed by conventional cryptography coming from quantum computing. So a lot of people assume that distributed ledger technologies are the obvious choice for building the CBDC. I've said this many times that I think decentralization could have benefits with respect to resilience and redundancy and security of a core ledger, whether it's for a CBDC or anything else. But there are some drawbacks that are there, and in fact, it might not be strictly necessary. Decentralization may have undesirable effects for other aspects of the system, like governance, especially DLT or blockchain that's permissionless. It could introduce some complexities that may not be necessary. And the tech folks are saying, well, perhaps we could have some of the benefits of DLT by using alternative and well-established management strategies. I think it's fair to say we just don't know. There's so many challenges on the technical side that still need to be resolved, and so the bank is assessing all possible approaches, including DLT. So with regards to the API, there's a lot of experimentation going on. The bank's working with the BIS Innovation Hub on Project Rosalind. And that seems to be going well. It looks like there's a set of API functionalities that could enable close collaboration between the public and private sector in developing this retail CBDC ecosystem. And there are other projects that are underway to look at other aspects of CBDC, including cross-border payments. I saw this morning that you heard about Project Icebreaker, which has some exciting features and, as you probably heard, some challenges too. I think it's too soon to know if all these challenges can be met, but I think that this work should continue even if there's no digital pound in the end. And I think that's a real question to ask, but I come out on that we should keep working on it because the tech underpinning digital money is going to be developed in the private sector anyway. And so I think it's essential that the Bank of England and other central banks have hands-on experience with these types of technologies to help support safety and soundness in that context as the private sector is using it. So I'm going to conclude by saying that it's often said that it's trust, not money, that makes the world go round. And I think there's a lot of us here, given what I heard so far, that agree with that. In fact, I think trust is the biggest hurdle that a CBDC needs to overcome. And that's the case for private money as well, any form of money. It's critical because of that governments and central banks stay focused on the core public policy objectives of a CBDC, and that they take steps to alleviate these concerns about mission creep. Before any decision is taken to launch, they have to be confident they've mitigated the financial stability risks in CBDC policy and design, and they need to be confident that they've passed that really high bar with regards to the technology. I think that the UK's transparent and consultative approach to developing the digital pound is consistent with the principles that I just set out. Of course, the CBDC work is generating considerable debate, not just here, but in the US, everywhere. And I see that as really healthy, and I would encourage a lot more of it. Money is a matter of purpose and trust, and it's too important to be left solely to the central bankers. You seem to be...
Careful.
Yeah.
You seem to have stuck to the cable.
Stuck me to the floor.
Thank you very much. That was a clear and powerful exposition of the case. Thank you very much indeed. A copy of Carolyn's speech is available on the Bank of England website. It's up there now, as well as the other two consultation papers that she referenced, so you can get hold of that. Can I ask, before I pass to questions from the floor, what are going to be the triggers that decide whether we go with this or not? Let's assume the various people, various working parties solve the technology platform question and design the functionality and figure, yes, this can be done without wrecking the banking system. What's then the trigger that decides whether we go for one, and who's going to decide?
Well, the triggers have to be that they've met all the tests that I just set forward. That's got to be the minimum thing. I think after that, though, it's really going to be about where they think the level of need actually is, and that's going to be a function of the relationship with the use of cash as it declined even further. Because that really does affect this wide and continued usefulness of central bank money. The second thing will be related to what maybe other major central banks are doing. If you're part of a monetary system and you're thinking about keeping that monetary system relevant when everybody else is issuing a CBDC, I think that would be a factor, as well as what the private sector is doing with respect to stable coins, particularly those that are not denominated in fiat. And so those number of factors will come together to say it's time at least to test this out and have a pilot. The risk of not doing the work now is because it's so complicated and it takes a long time to get it right. You hate to be in a position where you felt you needed to issue it in a short order and not be ready.
So do I draw from that the inference that for a major nation with a major significant currency, that issuing CBDC is going to be a matter of must, not whether, that it's an issue of sovereignty and of macroeconomic control rather than, shall we say, a capricious whim?
I think it starts with a sound monetary foundation and whether you think central bank money that's relevant is a part of that. I mean, we saw in the, and then after that, it's monetary sovereignty for sure. You know, we saw in the, you go back in history to the national bank era and there was national bank notes where the monetary system could work with purely private money. But there needed to be a lot of regulation. Eventually, there was even insurance of these national banknotes to make it as safe as it could be. And then finally, the decision was taken just to have central bank money. And that's kind of a bit of US history. And so it's not impossible to have a system that relies solely on private money. It's whether or not can it be made as safe and sound as one that has central bank money that's widely available and useful at its core. And I think that's the fundamental decision that needs to be taken. That question is not a whim. That's a very fundamental question. After that, you know, the likes of Libra or other kinds of stable coins that aren't denominated in fiat, even stable coins that are linked to the US dollar or to the pound, that are fully backed, kind of look like a narrow bank. Those are all going to be considerations about how they might affect the ability to do monetary policy.
And one of your brightest students at Princeton may well ask, well, given current events in American banking, isn't the private money essentially being backed to the hilt as a matter of public utility?
Well, certainly there was more backing than anybody would have expected ex ante, given that uninsured deposits for the two institutions that failed, they were made whole. Of course, you know, any losses would be covered through, you know, fees on the surviving banks. But yes, at the end of the day, I think that's the part of what I was saying is that it may be that you need to change the nature of your liquidity facilities in the context of a central bank digital currency. But you need to keep in mind that those liquidity facilities and other safeguards are needed whether you have a central bank digital currency or not. And so for me, the question is really about if what you're talking about is a retail CBDC that's got a very narrow core purpose as money, kind of like cash does, then I think you're just replacing one thing with a digital form, and you need to deal with the potential negative spillovers that might have through your safeguards and the rest of your policy framework. On the run side, with SVB Bank and the others, it's clear from any analysis you can do that their first point of departure is to think about prudential regulation and supervision and to strengthen that.
Are there any questions from the floor? Yes, Vanessa.
Yeah, I just wanted to get your thoughts on how do you see this kind of changing demand for safe haven assets? I ask because of the impact on kind of liquidity and capital ratio requirements.
So there's some research out there that it depends what you mean by safe assets. So I was thinking of where people are flying to in the US right now to money market funds, kind of viewed as being private but safe, and they've got sort of a convenience factor to them as well. Some of the research says that a CBDC could actually, it's not deposits that would only be affected, it could be these other instruments. And then the decision needs to be taken about whether or not you think that's a good thing or a bad thing. And of course, those who believe that the money market funds have risks that are not perfectly managed through regulation, that wouldn't be necessarily a bad thing because there's too much money flowing there given the risk. And at the end of the day, again, if you look at the list of liquidity facilities that get put up, and it's not just the US, it'd be Canada and other countries, they tend to include in there these short-term instruments that are viewed as safe, but then need to be backstopped by the central bank when there's a financial stress. I don't know if that answered your question. Hope it did.
Thank you. Victoria Cummings, RTGS Global. I'm quite interested actually in the aversion to programmability of CBDCs. I would have thought potentially CBDCs could be a good opportunity to introduce good programmability. And you mentioned food stamps, and I try to imagine an America where food stamps could be used for things other than food, and I'm not sure that that would be a good outcome. So I'm just wondering if that's peculiar to the UK, or if you know how other countries may feel about programmability of CBDC, and whether in fact there may be some central banks that are excited by the idea of being able to program CBDCs.
Well, there might be. I understand there are some pilots that have some programmability. I think my point isn't that there are certainly, you can imagine programmability that could have social value, that could be beneficial. Just think about what we went through with COVID, and you needed to get checks to people, or you needed to get deposits put into their accounts, and if you had you could put that money in their wallet, their CBDC wallet, then that's a very efficient way to get money to people very quickly. The concern I have isn't about the good parts of it, and I'm not even suggesting that any government that in a country where I live would do anything untoward with respect to that privilege to have programmability. It's just that it seems to be something that people are very worried about. And I don't think that in building this, you can ignore what people desire and what they worry about if you want to build trust. And you saw with just Nigeria that wanted, my understanding, they wanted people to adopt their digital currency. They thought maybe limiting cash or getting rid of it would be a way to force it. And it didn't go very well, because again, that undermines trust. It's saying we're going to force you to do something. And so you can think of very dystopian things that could happen with programmability in the hands of governments. That why go down that road if you can find other digital means to do that other objective, which isn't strictly speaking a core money objective.
Two more questions. Gentleman over here as well.
Thank you. Maurizio Ghirga, Italian Central Bank. The recent banking crisis highlighted a new characteristic, that is the speed. The speed, the flow deposit was very, very fast, incredible actually. Do you think that the use of CBDC would even increase the speed, or would enable central banks to know immediately actually this kind of scenario? Because now probably you know the problems at T+1 when the deposit is settled. If you have a central ledger, probably you know immediately if there is a banking crisis. So
it certainly would be an earlier warning indicator than the one we have now, potentially, given the data would be there. Would it increase the speed? I think it would. I don't know the answer to that question. It would certainly, to the extent that wallets of CBDC were more widely distributed across the population than access to money market funds or access to having to go to another bank and set up a new account, and it could be an enabler for a wider range of people, and so in aggregate increase the speed. That's a definite possibility, and even those who may not have loved a CBDC beforehand might all of a sudden discover the value of it and create wallets to do that. So that's why there needs to be this thought process, serious thought process through policy and kind of what are the guardrails for that. I think the run's happening anyway, and I don't know if much faster than what we saw is really going to matter to outcomes. I think that the worry that I have is that we kind of think that somehow running to private sources of safety, which may not actually be safe, or may not even be in your own currency, because flight doesn't just occur in your own currency. It can happen to others, and think about the capital flows that were mentioned earlier. I think that we really need to question whether or not it's better that the flight to safety stays in the private sector, or whether it goes more to public sector and then it's recycled. The answer to that, I know I'm sounding like I'm on the fence, is because we really need to think that through. It's not clear to me, but the two things are clear to me is that not all places that people are running now are safe. And two, I think that it's not clear to me that it's worse to have them going somewhere where it's safe, and you know that at least that's not going to be a second round destabilizing force.
The final question.
Marcus from Bank of Spain. Two quick questions on financial stability. The first one is one possibility to manage the problem with the flows of deposits is to use some limits on the holdings, but this could create also more complexity, less convenience for the central bank. Then what is your opinion on this trade-off? And the second one is if we should not differentiate it between the transition plan and the transition phase to run CBDC and the effects on deposits, and the steady effect where the banks need to compete for deposit. We should not differentiate these two phases. Thanks.
So I didn't get the first trade-off between the limits and what was the other, sorry, I'm sorry.
The two phases, the first one in the transition and the second one in the state.
Oh, two-tiered remuneration? Ah, yeah, okay. Thanks for that. So for the first one, I think that the limits are just simpler. People understand them. The two-tiered system brings on the table a remuneration, which I think is not only a slippery slope from the public's point of view, but also creates complications, because then if you think about implementing monetary policy, you'd have to think through how you have those kind of two different instruments. And so if you don't need it, then why would you do that? Now, of course, if you were thinking you wanted remuneration anyway, then that might be a sensible thing to do. I think that in the case of fear, I'm not sure remuneration really is in there, because you're not thinking about, do I want 2% or 3%? You're thinking about, do I want my money at all? and so there's that. The transition thing, it's really hard to say, because it depends on how things turn out in terms of the transition phase and how we see people adjusting. And so I wouldn't want to say right now. I guess to drop that, though, you would have to be sure that you had some other kind of way to throw sand in the wheels or slow things down if there were a run, and then or recycle that money back into financial institutions. And so there are ways to do that, but those would need to be worked out before you let go of those, if ever.
Karen, thank you. That was absolutely excellent. We could go on for hours, but you don't want to go on for hours, and we're standing between these good people and a welcome drink to which you're all invited.
Thank you.
Thank you very much indeed. If you can bear with me for another 30 seconds, I will formally close today's activities with thanks to all the panelists, presenters, speakers, and to you, the audience, here in London, and the 1,000 or so people online around the world, some of whom are just about preparing for bed, and some of whom are having their avocado on toast with their flat whites in California.
That would be in Australia.
Yes. Thank you to all. Please join us for a brief drink and to continue the conversation. Karen, thank you once more again for a superb presentation, and we look forward to continuing the discussion with you. Thank you.